Today we're going to talk about something that can be a little scary, but it's really important to understand. Banks, ladies and gentlemen, don't actually keep all of your money on hand. In fact, they only keep about 10% of your deposits in cash. This is because of something called the reserve requirement, which doesn't require them to hold more than that. And the less cash they have to keep, the more money they can create. This means that if everyone decided to withdraw their money from a bank at the same time, it would cause a run on the bank because the money isn't really there. It's been lent out or invested. A recent example of this fragility was Silicon Valley Bank. This bank failed because the money you put in a bank account doesn't just sit there. The bank uses up to 90% of those funds to invest where they think it will grow the most. Silicon Valley Bank, for example, invested in 10-year treasury bonds, which at the time offered a low return, around 0.5%. Everything seemed safe until interest rates started to rise. Suddenly, new bonds were offering 5%, which led many customers to withdraw their money to chase those better returns. The bank, under pressure to meet those withdrawals, was forced to sell its investments at massive losses, which ultimately led to its collapse. This problem is not new, but in the digital age it's even worse. Before, people had to physically go to the bank to withdraw money, which gave institutions time to react and prevent a total collapse. Now, with mobile apps, you can empty your account from anywhere in minutes. If too many customers do this at the same time, the system crashes. A recent case was iYang, where at certain times the application stopped working, causing concern among users. This kind of situation has led many people to look for alternatives. Nowadays, more and more people are keeping just enough in the bank to cover basic expenses, like their mortgage and bills, and investing the rest in other assets. We are not just talking about cryptocurrencies like Bitcoin, but a strategic diversification that protects against inflation and the risks inherent in the traditional banking system. Let's talk about inflation. For years, many of us believed that saving money simply meant accumulating it in the bank, but that's not entirely true. Inflation erodes our purchasing power. What you could buy 5 years ago with 100 euros now costs much more. This means that even though it seems like you're saving, you're actually losing value. Inflation is not only reflected in higher prices, but also in the reduction of product sizes. This phenomenon is known as shrinkflation. For example, that fast food meal that used to look plentiful is now noticeably smaller. This is another way in which our money loses value without us realizing it. The problem is that we have short memories. Remember the case of electricity bills. A few years ago, paying 60 euros a month was normal. Then, the increases brought the price up to 500 euros. Today, paying 140 euros seems acceptable in comparison, but we've forgotten that we used to pay much less. We adapt to the new figures and move on. Faced with this situation, cryptocurrencies have emerged as an alternative to the traditional financial system. But there are risks here too. Many people see cryptocurrencies as a way to double or triple their money quickly. However, this view is dangerous. Cryptocurrencies should be considered a long-term investment. Buying Bitcoin, for example, should not be done with the expectation of getting rich in a week, but with the goal of protecting your wealth against inflation and devaluation. If you invest in cryptocurrencies out of fear of missing out, FOMO, you will probably end up losing money. The key is to adopt clear and disciplined strategies. One of the most effective is known as dollar cost averaging, DCA, which involves investing a fixed amount regularly, regardless of the market price. This strategy eliminates the anxiety of trying to predict the best time to buy. Another strategy is to keep a portion of your capital liquid, either in cash or in stable coins like USDC. This allows you to take advantage of opportunities when the market drops 20 or 30%. In those moments of panic, prices are usually more attractive to enter. Cryptocurrencies have proven to be volatile, but they also offer unique opportunities. That's why it's important to diversify. A good strategy might be to allocate 60% to Bitcoin, 30% to established altcoins, and 10% to riskier projects with high return potential. The important thing is to maintain balance and not bet everything on uncertain assets. Another aspect to consider is how large financial institutions relate to cryptocurrencies. Investment funds often buy Bitcoin and other digital assets because they have an obligation to generate returns for their clients. This means that at certain times they sell large quantities, causing price drops. Understanding these cycles is crucial to avoid impulsive decisions and make informed choices. Going back to the topic of traditional banks, more and more people are realizing that they cannot rely solely on them. Diversifying your investments not only protects your assets but also gives you more control over your finances. Whether through cryptocurrencies, real estate, or mutual funds, the important thing is not to put all your eggs in one basket. In conclusion, the banking system, inflation, and cryptocurrencies are all deeply interconnected. Understanding how they work and adopting clear strategies can make the difference between losing value over time or building a solid financial future. Making informed decisions, diversifying, and maintaining a disciplined strategy are the pillars of protecting and growing our wealth in a financial world full of uncertainty. Today is the time to start taking control of your finances. Remember, knowledge is the most powerful tool you have to face economic challenges and build a stable financial life. What steps are you taking to protect your assets and secure your future? Share your strategies, and let's keep learning together.